what goes into your credit score, how to start building your credit score, and the ugly truth about inquiries. I'm Joe Chavarria, and this is how to raise your credit score by 100 points. So, guys, before I dive in, I want to just encourage everybody to like, share, and subscribe to my podcast or to my channel here, and so you can get the latest and greatest information. I stay constantly ingrained in the world of credit, whether it's business or personal credit scores. I stay up to date with all of that. So if you want to get the up-to-date information and kind of get a cleaned up version, to kind of give you the bullet points and the nugget pieces of all the information, feel free to subscribe so you can get the latest and greatest. Also, if you need help with your credit score, if you're interested in raising your credit score, please comment yes below or no below, just so I can kind of get an idea of who my audience is, so I just know to deliver content that resonates well with you. Okay, so first thing I want to talk about is what goes into your credit score. So it really just depends on which score is being used. So there's two main credit scores right now in the, consumer credit space. There's your Vantage credit score, and then there is your FICO credit score, which is the most popular, which is the most commonly used credit score by mortgage companies, auto companies, credit card companies. Most of these banks and lenders are using a FICO-based credit score. Vantage credit score is actually not really new, but it is fairly new. It's gaining a lot of traction, a lot of popularity, with Credit Karma being one of the biggest, companies that provides Vantage credit scores. Of course, they don't really publicly say that. Their commercials are centered around, hey, get your credit score, find out what your credit score is for free. But if you want to get a little specific, you have FICO scores, you have Vantage credit scores. So with FICO, there's close to 10 at the time I'm making this video. Probably, if you're watching this years later, there may be more versions, but there's about 10 versions of FICO scores right now, and about 4 versions of Vantage. And with each version, of score, the algorithm changes. Certain accounts on your report matter more. And that's typically the main reason why there are different versions, to kind of go with the market as the market changes, the industry changes. So let's talk about FICO, because that is really the most important score right now. It is the most commonly used score model right now. With FICO scores, you have payment history, which is your biggest component of your score. It's about 35% of your score. You have utilization, or balances, or credit limit, or available credit is another way to put it. That's about 30% of your credit score. Then you have length of credit, which is 15%, and then mix of credit and type of credit being 10%, and new credit or inquiries being the remaining 10%. And so within each of these categories, within each of these components are like subcomponents, or different reasons as to what it would influence that component. Like, for example, within payment history, you have, let's say, the last time that you were 30 days late, or 60 days late, or 90 days late, right? And let me kind of back up a little bit and just kind of first explain what is a credit score, why, how is it really determined, what is the purpose of it. So a credit score is really nothing more than the likelihood of you going 90 days delinquent in the next 24 months. So it's like it's like gambling. It's like, what are the odds, what are the chances of you as a consumer going 90 days delinquent in the next 24 months? It's really what the banks and lenders mostly care about, is what is the probability of this person not paying us, meaning, statistically, if a consumer goes more than 90 days delinquent, the odds of them paying the bill is really, reduced down by 50% or more. So what are the chances of this person not paying me ever again, compared to this person actually paying me? So therefore, the credit score would actually, it's a 3-digit numerical number that would basically warn and tell lenders what is that likelihood. It ranges from 300 to 850 regarding FICO. And so the higher the score, the closer to 850, the less of a chance that person's going to default, or you as an individual is going to default on any future obligations. The lower the score, the more likely you are to default, and therefore you're a higher risk, being left to pay higher interest rates, more fees, or being denied for credit, altogether. So that's really what a credit score is. And so the components that go into it, those are the 5 major components: your payment history, your available credit, length of credit, type of credit, and new credit, or also inquiries. So now I want to talk about how to build credit. Like if you're starting off for the first time, how do you build credit? What's the best way to start building credit? And really the best way to start building credit is to understand what is a good mix of credit. So a good mix of credit, you don't want to get too many installment accounts. Those are like auto loans or personal loans or store financing like Cons or Aaron's, some of those companies that provide in-house financing. And you don't want too many credit cards, or you don't really want too many mortgages. You kind of want a good, healthy blend. And by FICO standards, a good blend of credit would be one mortgage, one installment, and 3 to 5 revolving accounts. So with that said, when you're starting to build credit for the very first time, I would recommend that you start off by getting like a secured credit card. Secured credit cards are a great way to start building credit. When you have zero credit, it's very tough to get approved for a credit card to start building credit. And so, you really, that a secured credit card is where instead of a bank or a lending institution determining if you are worthy of credit, instead of them using your credit report and your credit score to make that deciding or making that decision, you're with a secured card, you're basically putting the money up front. You're borrowing against your own money, and you're taking the risk on yourself. And so, with good secured credit card companies, you're guaranteed to be approved because it's your own money. You're taking a risk on yourself. Many of them don't have any credit checks. There's a couple that we recommend. Some banks require credit checks for secured cards, which I don't understand why if the consumers put the money, but you probably want to avoid the ones that require a credit check or there's a risk of being denied, and go with the ones that don't require a credit check and it's guaranteed approval. So getting yourself like a secured credit card. Also, there's some other options to start building credit, like there's a online jewelry store, which is called the Online Jewelry Club. There's a Hutton Chase account, which is an online store. They'll approve it. They'll approve everybody for a $1,500 credit line. They report to Equifax and TransUnion, and you can buy items on their website, and then they'll report on your credit as a revolving account. And then of course the online jewelry store, they'll approve you up to $5,000. You can buy just jewelry on their website. And like I tell people, when you're starting off for the first time building credit, I understand it's not like the Chase or the Discover cards or the American Express credit cards, but you kind of need to start somewhere. You need to build credit somehow. And so you kind of want these as like stepping stones to get to the point of getting more attractive credit cards. And you just want to start demonstrating good credit behavior with these accounts. And then getting yourself like an installment account. I wouldn't recommend just going to get a car loan just because you don't want to get too far into debt, but maybe like a small personal loan. There's companies like World Finance, Security Finance, One Main Financial. I know that World Finance typically approves just about everybody, but not everybody, but just about. And they'll usually give you like a little starter loan between $200 to $300 for your first time. You pay back, let's say you borrow $300, maybe you pay back $375, maybe $400 when it's all said and done, and you pay it over like 4 to 6 months, something like that. And those payments will get reported to your credit report. So those are some great ways to start building credit on your own. But if you have a significant other, or if you're a student and you're still living with your parents, maybe see if mom and dad can add you to one of their accounts, as an authorized user, and then using that to be able to go get some other credit cards of your own by leveraging the credit history from their account. Probably make sure that their account is got a low balance, it's being paid on time, never late, so it's not really counterproductive. All right, so I want to kind of segue to inquiries a little bit and kind of go over the ugly truth around inquiries. So with inquiries, you have soft inquiries, you have hard inquiries. So soft inquiries, and sorry guys, I'm a little shaky here with the camera. With soft inquiries, those are like promotional inquiries, or those are like if you check your own credit on a website and you're not really applying for credit, or if you get a pre-screened offer in the mail. Those are soft inquiries. So it's not like you're actually going out there and seeking the credit. You're trying to get approved for a loan or approved for a credit card. So any non-credit seeking inquiries, those are going to be considered soft inquiries. And just so you know, you can check your own credit report online. You can contact the credit bureaus and request a credit report. You can check your credit report as many times as you like, and it's not going to affect your credit as long as it's not being as long as it's not a credit report from a lender and they're having to run your credit report as if you're applying for something, that's considered a hard inquiry. So hard inquiries are going to be like your auto loan applications, your mortgage loan applications, your credit card applications. Those are typically your hard inquiries. And so with inquiries, inquiries only stay on your credit report for 24 months. They only impact your credit score negatively for 12 months. And if you are seeking business credit, if you're a business owner and you're seeking some business credit or trying to get approved for a loan, most lenders really don't want to see more than 3 hard inquiries in the last 6 months. And so if you're a business owner, try to keep those hard inquiries to an absolute minimum over the last 6 months so you have a better chance of getting approved. Now with inquiries, one of the truth about inquiries is that, if you're shopping around, let's say for a mortgage, as long as the inquiries are within 30 days of each other, they're going to be treated as one. So this is called deduplication. It's really to allow the consumer to rate shop. So as long as you are, sorry for all the shakiness, guys. So sorry, as long as you are, not applying for a bunch of credit cards. So credit cards are inquiries that are not deduplicated because typically if you get approved for a credit card, you're not really going to kind of hold off and shop around for other credit cards because of interest rates. Most people who get approved or apply for a credit card and they get approved, they usually end up taking it. But with like a mortgage, for example, let's say one bank approves you at a 5% interest rate and you're not completely thrilled about that, to not penalize you for shopping around for a better interest rate, deduplication kicks in if you have like another mortgage inquiry, let's say a week later from a different lender, and they approve you for 4.5%. So that way you're not penalizing your credit score. One, there's a 30-day grace period to allow for the rate shopping, and then at the end of the day, as long as the inquiries are close to each other, they're going to be treated and scored as one. Both companies by law have to show up on your credit report because they requested your credit report, but when it comes to your FICO score, they'll be treated as one inquiry. A lot of people don't know that, so when they apply for like an auto loan or a mortgage application, they kind of avoid shopping around because they don't want to ruin their credit. And truth of the matter is, this does not ruin your credit. This actually is a good thing to do, to shop around for a better mortgage, the best interest rate on auto. So that is actually the ugly truth, guys, around inquiries. A lot of people believe that too many will destroy your score, and inquiries really only account for about 10% of your credit score anyway. So it's not the biggest component of your score. It's a smaller fraction of it, but those points can kind of add up. You can start losing quite a bit of points pretty fast. You have a bunch of credit card inquiries back to back, or just a lot of inquiries in general the last 3 to 6 months. The more hungry you look for credit, the more of a risk the banks see you, or at least FICO will see you that way, to warn lenders that, hey, this person is seeking for a lot of credit, so they may be cash poor or something's going on, so you may want to charge a higher rate, or maybe not approve them at all, so therefore your score is going to be lower if you have a ton of credit seeking inquiries back to back, and especially over the last 6 months to a year. So that's my time, guys, and hope this information was helpful. Again, if you are looking to repair your credit, comment yes below if you're looking to raise your credit score, or no below if you are not. And don't forget to like, share, and subscribe to my channel. And as well, if you want a free credit consultation, I own a credit report company. I've owned it since March of 2012. If you want a little bit more information, you want to have your credit report looked at or have your situation looked at, my team and I are more than happy to do that at no cost for you. So just give us a call. You can reach us at 800-786-2120. That's our main line. That's 1-800-786-2120. Or shoot us a text message to our main line, which is the local number, 281-756-7060. Tell them Joe sent you. Again, that's 281-756-7060. Shoot us a text message or give us a call if you want to set up a free consultation. And you can check us out online at www.thecreditagents.com to learn more. So thanks for watching, guys. That's my time. Hope this information was helpful, and I'll see you on the next video.